Welcome back to Iron Financial. Look, our mission here is really simple, right? We are here to help you forge a stronger, far more resilient portfolio. We want to help you cut straight through all this market weakness. And today, well, we've got a massive explainer lined up for you. We are putting Paramount Skydance, ticker symbol PSKY, right under the microscope. We're looking closely at their Q1 2026 earnings report. And let me tell you, there is just so much noise out there right now. When you've got a massive, literally industry-shaking merger on the horizon, the corporate hype can be absolutely deafening. We're talking about the colossal consolidation of legacy media empires in an era where streaming is fundamentally rewriting the entire rulebook of wealth generation. But, here at Iron Financial, we do not buy the hype. We buy the blueprints. We're going to look at the cold, hard numbers to see if this company is actually building something durable in what is, frankly, a very fragile macroeconomic environment.
Yeah, and that's exactly the hard question we really need to ask right out of the gate here. Is Paramount Skydance's recent headline profit actually a solid foundation? Is it something that you, the retail investor, can build real, lasting wealth on? Or, with this impending Warner Bros. Discovery mega-merger just looming over absolutely everything, is this actually a massive debt trap that's just cleverly disguised as a growth story? Look, management is throwing a lot of really flashy numbers at us right now, but when you are constructing an entertainment behemoth of this scale, one single bad structural beam can literally bring the whole thing crashing down. So let's not get distracted by a fresh coat of paint. We really need to get in there and check the foundation.
Part 1. Core Financials, the drill down. Let's get right into it.
Okay, let's dive into this and initiate the drill down. We're going straight into the core financials, extracted directly from their latest SEC filings. We literally need to separate what management wants us to see on their glossy corporate presentations from what the fundamental reality actually is. We are looking for true structural integrity here, folks. Are they actually generating real top-line growth, or are they just shuffling numbers around on the balance sheet to make the quarter look pretty before this mega merger closes? So the crucial point starts right here at the top line. For Q1 2026, Paramount Skydance reported total revenue of $7.3 billion. That is a 2% year-over-year growth. Now, I know that you're thinking, 2% might not sound like it's breaking the sound barrier, right? But in the current media landscape, any positive growth is literally the first heavy concrete block in PSK's financial foundation. You've got to remember, their competitors are out there seeing negative growth. They're flatlining entirely due to macroeconomic ad spending cuts. So holding the line and actually expanding slightly is a massive victory. It proves that across their three main segments, direct-to-consumer, studios, and TV media, they have enough load-bearing capacity to keep the overall structure moving upward.
But look at this next number. This is where the real heavy lifting actually happened. Adjusted EBITDA came in at $1.2 billion for the quarter. That is absolutely not a typo. Let me repeat that for you. That is a massive 59% year-over-year jump. This brilliantly illustrates that management's cost-cutting playbook, it's actually working. They aren't just trying to bring more money into the front door. They have completely stopped the bleeding out the back door. When you can take a relatively meager 2% revenue increase and forge that into a massive 59% jump in earnings before interest, taxes, depreciation, and amortization, well, that tells me the internal structural renovations are paying off big time.
And when you compare Q1 2026 to the exact same period last year, there is one metric that demands your absolute laser focus. It's the margin. They went from an operating margin of roughly 10% last year to a highly durable 16% this quarter. The operating income actually hit $616 million. This is huge because it proves that their disciplined expense management isn't just some empty talking point they threw on an earnings call to appease Wall Street. It's a structural reality. In a weak, highly volatile market, margin expansion is your armor. And right now, PSKY is putting on a lot of heavy armor to weather whatever macroeconomic storm comes next.
So what segment is doing the heaviest lifting to support those margins? It's direct-to-consumer. DTC revenue forged ahead by 11% to hit $2.4 billion. Paramount Plus specifically saw its revenue jump a massive 17%. But here is the real steel beam in the structure, guys. Average revenue per user, or ARPU, is up 14%, and that's driven heavily by that January price hike. Furthermore, the DTC segment improved its adjusted EBITDA to a positive $251 million, flipping from a loss a year earlier. They are actually making real money on streaming now. Okay, hold on, let me just stop you right there for a second. Because I'm looking at the subscriber additions. You've got 2 million underlying ads, sure, but the headline net ads, they're only at 700,000. In these incredibly cutthroat streaming wars, 700K net ads is a distinctly weak quarter no matter how you slice it.
Are they hitting a wall here? And honestly, more importantly, what happens when the temporary revenue boost from that January price hike inevitably fades? Are viewers outright rejecting the new pricing model?
I get why you'd ask that, but the critical context behind that 700,000 number is exactly what management isn't splashing on the front page. They intentionally shed over 1 million international hard bundle subscribers during this quarter. Why would they do that? Because those subscribers had an ARPU of less than $1. They were absolute dead weight. PSKY management made the deliberate, really tough choice to cut the low-margin fat. You don't build a durable skyscraper with cheap, faulty materials, right? And you definitely don't build a profitable streaming service by heavily subsidizing millions of viewers who pay less than the cost of a cup of coffee per month. This was a strategic demolition. They did this to forge a stronger, much more profitable portfolio moving forward.
And look, the strategy on the content side is yielding incredibly high ROI. Just look at this viewership comparison. The main CBS UFC fight cards average 2.8 million viewers. That is approximately 50% higher than ABC's NBA primetime game on the exact same night. Think about that structural advantage for a second. More than 10 million households viewed over 100 million hours of UFC content across their platforms, and here's the absolute kicker. Those UFC subscribers average 15 years younger than their legacy base. Advertisers pay absolutely massive premiums for young, highly engaged live audiences, which gives PSKY incredible pricing power. They are pouring a completely new foundation with a demographic that actually pays the bills.
All right, part 2, cracks in the armor, the skeptic's view. Let's really get into it.
Okay, that all sounds great if you only look at the top-line gloss, but my job is to walk the construction site and find the code violations. It is time to look past the hype and really dig into the 10Q filing. Because folks, when you peel back the drywall here, there are some serious, undeniable cracks in the armor. This is the skeptic's view, and if you're putting your hard-earned money into PSKY, you need to be intensely aware of these structural weaknesses. Here's the most glaring crack in the entire operation. Yes, direct-to-consumer grew 11%. We saw that. But look at the legacy TV media segment. It dropped 6% down to $3.7 billion. That is still their largest revenue driver by far, and it is actively, undeniably shrinking. This isn't just a temporary blip. These are deep, structural headwinds in the advertising market combined with crumbling affiliate fees. Cord cutting is a massive earthquake that hasn't stopped shaking, and PSKY is highly exposed. You cannot just offset a collapsing $3.7 billion legacy business with a few UFC fights and temporary price hikes forever. Eventually, that roof caves in.
But let's talk about the absolute lifeblood of any business, okay? Cash. Let's look at this drastic cash bleed. In Q4 2025, they were sitting comfortably on $3.3 billion in cash and cash equivalents. Just one single quarter later, Q1 2026, that pile has dwindled down to $1.9 billion. I want to really emphasize the math here for you. They lost $1.4 billion of liquidity in just 90 days. That is a burn rate that should make absolutely any retail investor sweat bullets. You really have to ask yourself, do they actually have the cash reserves to withstand a broader market weakness, or are they burning through their safety net right before the biggest, most expensive merger in media history?
And believe me, it gets significantly worse when you look at free cash flow. For the uninitiated out there, free cash flow is the actual cash a company generates after accounting for capital expenditures. It is absolutely essential for debt repayment and, successfully funding mega mergers. PSK's Q1 free cash flow dropped to just $96 million. Last year, it was $123 million. Management is actively blaming this on transformation costs to the tune of several $100 million that are weighing heavily on their cash generation. But what does that mean practically for us? It means massive severance packages, it means shutting down redundant technology, and it means paying exorbitant consulting fees. So right now, the sheer cost of simply trying to transform this company is actively eating into its financial foundation.
Part 3. The WBD mega merger. Heavy lifting. Time to look at the bigger picture.
Okay, those are totally valid points. But you really have to understand, they are short-term growing pains for a massive, long-term structural overhaul. Let's pivot to the elephant in the room, the upcoming Warner Bros. Discovery mega merger. This is the heavy lifting I've been talking about since the beginning. Yes, cash is down, and yes, there are heavy transformation costs right now. But that is precisely because PSKY is currently building the complex scaffolding for the most massive media consolidation of the decade. Let's break down the blueprint. Here is the aggressive timeline they're executing against. In Q1 2026, the U.S. Hart-Scott-Rodino obligations were officially satisfied, meaning they successfully cleared the major antitrust and monopoly regulatory hurdles. That is huge. Then, in April 2026, they secured the critical WBD shareholder approval. Management has explicitly stated on the record that there are no statutory impediments remaining. The ultimate test of durability is set for September 2026. That is the target close date. They are moving at absolute breakneck speed to get this colossal structure fully permitted and built before the end of the year.
Breakneck speed is right, but the cost of that speed is frankly terrifying. Let's talk about the financing scaffolding they've erected just to hold this thing up. Sure, they secured $10 billion in permanent financing, and they syndicated a massive $49 billion bridge loan, which, let's be real, is just a short-term lifeline meant to cover the massive gap until permanent funding is sorted out. But look at the massive debt figures they've saddled themselves with. They are dragging $15.5 billion in higher gross debt directly into this new entity. And remember that cash drop we talked about earlier? A massive chunk of that was drawing $2.15 billion from the revolving credit facility. They are essentially putting this on the corporate credit card. And they did that just to help fund a staggering $2.8 billion termination fee related to the transaction. They are leveraging themselves to the absolute hilt to make this deal happen.
I hear you, but they aren't just blindly taking on debt, okay? They are executing massive internal renovations right now to ensure the post-merger entity is highly efficient and incredibly resilient. By mid-year, they are entirely on track to consolidate BET+, Pluto, and Paramount+ into one unified tech stack. More importantly, they have achieved a major milestone with their Oracle Fusion ERP rollout, targeting early 2027. For those watching, an enterprise resource planning system is essentially the digital plumbing of a company. If you are going to merge with a giant like WBD, you need flawless plumbing so you don't collapse under your own operational weight. This tech integration is an absolutely crucial reinforcement to handle the massive incoming scale.
And their engineering adoption brilliantly illustrates how they are tightening the bolts on their massive cost structure right now. They aren't just cutting staff blindly, they are radically upgrading their core capabilities. Approximately 80% of their engineering teams have adopted AI code assist tools. This adoption has cut approval times by over 50% and vastly improved productivity company-wide. They also launched Precision Plus, which is an AI-powered ad product that is already completely outperforming its benchmarks. How? By delivering vastly superior audience targeting and drastically lowering customer acquisition costs for their advertisers. They're using AI to forge an incredibly lean, high-output operational machine that is fully ready to absorb the WBD assets.
Part 4. The verdict: opportunity or trap? All right, we've drilled down into the Q1 earnings, we've exposed the structural cracks in the legacy media business, and we've reviewed the massive, expensive blueprints for the WBD merger. It is time to bring this explainer to a climax. We need to deliver a final, unfiltered verdict on PSKZ's true market strength.
Let's lay it all out on the table right now. No corporate spin, just the raw materials we have to work with.
Look, management has firmly reaffirmed their 2026 targets, $30 billion in top-line revenue and a massive $3.8 billion adjusted EBITDA goal. Now, sitting at a $7.3 billion quarterly run rate, hitting that $30 billion annual mark is highly realistic. In fact, they are pacing just ahead of it. From where I am sitting, the foundation they poured in Q1, that rock-solid 16% margin, the $251 million positive EBITDA in streaming, the ruthless, calculated cutting of unprofitable international subscribers, all of this proves that this foundation is built to last. The WBD merger isn't a trap, it is the final structural phase to forge an absolute entertainment juggernaut that is going to dominate the next decade of media.
As CEO David Ellison said directly on the earnings call, and I quote, "We have had strong execution on cost saves and efficiencies and have been delivering against our plan." That right there is deliberate, intelligent capital allocation at work.
Yeah, well, delivering against the plan is great, David, but let's not ignore the $15.5 billion in gross debt that is hanging over this entire structure like a massive, unpredictable wrecking ball. The cash reserves have plummeted to $1.9 billion. Free cash flow is down to an absolute trickle at just $96 million. If the integration hits even a minor snag, or if legacy TV media collapses faster than anticipated, this highly leveraged structure could very easily buckle right under its own weight.
And that brings us to the ultimate question for you, the retail investor trying to build real, lasting wealth in a very volatile market. Are PSKY's Q1 results a rare opportunity to buy into a master blueprint right before the skyscraper goes up? Market skeptic? Or is this a heavily leveraged debt trap where early investors are just going to be left holding the heavy bag when the structural realities of cord cutting finally bring the whole thing crashing down? The numbers are on the table, folks. The blueprints are fully public. It's up to you to decide if PSKY has the iron required to build your portfolio. Thank you so much for joining us on this explainer. Keep your hard hats on, stay disciplined out there, and we will see you on the next deep dive.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.